All right, in this video we're going to go through the variables, right? So we talked a little bit last week, um, and we kind of hinted at the variables. We talked about market share, and we didn't really get into yet in this course some specific variables and ratios that you would want to be looking at to evaluate your company, right? So remember we talked and we explained that if this is, say, stock price, right, on your chart here, right, so you've got your chart, and this is graphing the stock price, that if you evaluate the company as being worth X amount of dollars, and you happen to notice that at that given time that the stock price happens to be trading a little lower, that then you would have a good opportunity to buy. And so, obviously not everybody that's watching this is going to be interested in trading stocks, but the key part of this that's important for everyone is learning how to evaluate the company, right? And so that's kind of the key. So we started off with an understanding of market share, and today we're going to look at some specific variables, and there are many variables that you can use. I'm going to give you some of the more important, or at least important as I see it. I mean, there's probably all kinds of other variables that, depending on what you're wanting to look at, may or may not be more important. But this will give you a good start as far as understanding some things to look at. Now, I've broken this into basically three categories of variable, right? So one of the first categories of variable is what we call fundamental variables. Fundamental variables. Now, fundamental variables do not take into account anything to do with the stock price of the company, right? So that's why they're fundamental. We'll look at some of the other ones. We've got one of the other ones that we'll look at is our kind of price to fundamental ratios, and then at that point you bring in an understanding of the stock price, which for a stock investor that's important. For a small business owner who's wanting to evaluate their own company, those variables are not quite as important. So for you, if you're just evaluating, wanting to know how to do your own company, the fundamental variables will be the most important. But we also want to talk about then how to understand fundamental variables by throwing in the element of price, right, which is the core behind value investing. All right, so fundamental variables. These are variables that describe the strength of the company, right? That the key behind value investing is that stock prices go up and down, sometimes not necessarily fully in conjunction with the value of the company, that the value of the company is not changing as quickly and sporadically as the stock price. And the reason for that is that the stock price incorporates human emotion, it incorporates all kinds of other variables, because it's actually people themselves on a computer somewhere who are trading the stocks, and their interactions, being fearful, greedy, whatever they're doing, tend to create the spikes and the troughs in the stock price. The actual company itself is not changing that rapidly, right? And so value investing says, let's take a look at the underlying strength of the company, and let's let that be the predictor of company value and not just stock price, because stock price takes into account the whims of people, and that's not really a good way to do it, because then you get caught up in excess, you get caught up in bubbles. A bubble is when a price of anything, it could be a stock or it could be a whole industry, like the real estate industry that crashed in 2006, 2007. It was spiking very high, and a lot of that was just because people were starting to pay a lot more and banks were willing to lend, and nothing changed with the underlying value of the homes. The homes were very similar to the homes that were being built 5 years earlier. Square footage didn't double and triple. The quality of materials didn't double or triple, but the price doubled and tripled. And so the same way that it worked with the real estate market, it also works with companies. That sometimes the greed and the way that people are pushes a price much higher, but the actual value never changed, right? And so often with bubbles, they come right back down to where they should have been in the first place. So if you're wanting to invest, you're wanting to understand a company, the better thing to do is not to pay as much attention to current stock price, although that does factor in. But it's really to begin with an understanding of the company. So this is why fundamental variables are really important. They don't look at stock price at all. They only look at the strength of the company, right? And so one of the first ones that I think will be important for you is return on capital. Return on capital. Now, the key to understanding return on capital, and for each of these I want to kind of at least explain it a little bit so you understand not only what is this, but what is the story that it's trying to tell, right? So return on capital means for every dollar of assets that you have, right? And you can define capital in a couple of different ways. Capital could be cash, or capital could be assets, right? Difference between assets and cash. Cash is an asset, but if you were to use it as assets in this formula, then that could include broader things. It could include investments. It can include real estate that you own. It could include your inventory. So how you define capital kind of determines the specifics of the math that you use, because if you're going to do return means how much money you brought in, right? So return is how much you got back. On capital is how much you used, right? So basically the idea is that if I have $100,000 in capital, how much money was I able to generate for the company by using that? Was I able, did I have, say if we had $100,000 in the company, right? Just to use some easy math, right? If we had $100,000 in the company, and we made, say, $10,000 for the year. Not too impressive, right? That's obviously 10%, right, of 100,000. And so your return on capital would be 10%, right? That you had 100,000, you brought in 10, so that means your total then becomes 110,000 at the end of the year. So you started with 100,000, you ended with 110. That's a 10% increase, so your return on capital was 10%. So the higher that you earn, the higher that number is, the better off you are, right? Now, 10% return on capital actually isn't that bad. Like, there's a lot of companies that would be very pleased with a 10% return on capital. The reason I said not too good is just because 10,000. If you're a smaller business, 10,000 isn't even going to hardly pay the bills. But the larger the company becomes, for a large company to have a 10% return on capital for the year is fairly good. The average stock market growth over the years has been about 7 to 12%, depending on which market you're looking at. So if your business produced 10%, that's pretty good. Now, while we're on this, let me just throw out there this principle of safe investing and how to use that as a benchmark. The government allows certain investments that are fairly safe, right? I mean, if you invest with the government in a government bond or government treasury of some sort, then the government traditionally will pay that back no sweat, right? I mean, for them to not pay back their debts, that means we got bigger problems than just the interest we're returning, right? So the American government has been what is considered in economics a safe investment, right? No risk would be the way that you would call that. So it's not that there's no risk. I mean, the American government could falter and have trouble. But in terms of economics, it would be considered no risk because the government has not ever defaulted on any of their loans or anything like that. So, as things are, there's no risk with doing a government treasury or government bond. So, if you're going to take on risk, like a business or investing in stocks, then it should pay more than the interest of the safe investment, right? So, for example, if you could get somewhere between 4 to 6% in a government treasury or bond or some kind of government investment, if you can get somewhere between 4 and 6% on one of those annual without any risk, because if you put it there, there's not going to be any risk, right? Because the government's going to pay that back, right? Or you can invest your money in equities, stocks, real estate, something, right? Some kind of other investment. Now, the other investment is not as guaranteed to return the investment as the U.S. Bonds or treasuries would be. So the idea is if you're going to invest, say, in stocks and take on all that extra risk, that it should produce more than this, right? Because if you're only getting 4 to 6% off of your stocks, then you took the risk for no reason, right? You could have just put it in this and not had to worry about anything of the potential of it going down, right? So that's where we kind of get the concept that the more risk there is, then the more return there should be, because there are low risk things that you can get a decent return on. And so if there's low risk things that you can get a decent return on, then there really is no point in taking on a bunch of extra risk like you find in the stock market, unless you're expecting higher returns, right? Okay, so return on capital, right, just to kind of get back to this discussion a little bit. And the reason I kind of went there is because this is personal return on capital, right? That if you're going to invest your money in something, you want to see at least 4 to 6%, because you could get that without running a business or without researching stock markets. You could just invest it in government securities and get at least around 4%. Now, right now, it is sometimes a little lower just because of the recession. So this is not a locked-in number. This is what it has averaged. Basically, what the government is trying to do with this is give you a place where you can invest and stay just a little above inflation. So inflation is generally 3 to 4% a year. And so if you get 4 to 6% from the government, they give you a place where you could put your money and it would stay just ahead. So they're not trying to make you rich, but they do want to give you a place where you could put your money and it grow a little bit and inflation not eat it up. Because if you just put it in a savings account where you're getting 0.25% or 1%, inflation's 3 or 4%, means you're actually losing 3% a year to keep your money saved if you're just putting it in a savings account, right? And so the government gives an opportunity. Now, currently, it's actually a little less than, I think it might be like 3.5% right now, so it's actually a little less than inflation, or maybe right at it, because of some government policies that they're trying to do to pull us out of the recession. But the idea is putting your money in a place like this at least is better than a savings account. It at least keeps you on par with inflation, right? Now, if you're wanting to grow your money, then that's where you come into businesses, equities, real estate, things of that nature. My personal opinion, I know this is not a personal finance class, but my personal opinion on this is that there should be an order, right? As far as priority, that your number one priority, if you're going to be a small business owner. Now, if you're just going to work for another company and you don't have any intention, desire, expectation to be a business owner, then this first one will not be in your priority list, obviously. But the first one, as far as a priority of how you would invest, I would invest first in my own small business. Because year over year, there's not going to be anything that's going to be as important in your financial health as making sure that the business that you manage is successful, right? You don't want to think about how to invest your money until you have a good investment stream, right? So if you're going to be a career person, and you're going to work at a job, and you expect to work at that job till you retire, then your income stream is somewhat set. And so then you want to start taking your money and maybe investing it in some other places. If you're a small business owner, your income stream is not set, right? Because you're the one that owns the business. You got to make it successful. It's not like going to work at some large corporation where you're going to get your paycheck every week fairly consistently. As a small business owner, if you don't make it successful, then there is nothing coming in, right? And so as a small business owner, your number one priority for investment has to be your own income stream, right? Your own small business. Then after that, I think the next core thing would be real estate, right? Getting your real estate. There's a lot of tax advantages for real estate owners. There's stability in real estate. If inflation goes through the roof, then the price of your real estate goes right along with it, right? So it's a hedge in some ways against inflation. As the prices of things go up, either the value of your real estate goes up or what you're charging for rent. If you're doing rental properties, things like that, as the inflation and the price of everything goes up, then you charge more rent and you're balanced out again, right? And so real estate is a good investment. Real estate doesn't tend to lose value too much over time unless you buy it at the peak of a bubble, right? If you buy it at the peak of a bubble, then you could lose a lot of capital right up front. Typically, if you're using real estate as an investment, you probably don't want to get into it looking for appreciation, right? So appreciation in this context means that you buy it and say you buy it for $100,000 and you're hoping to sell it for $150,000. That's a $50,000 appreciation. Because sometimes that could take a long time, and then when it does go up, that it could just be keeping it pace with inflation. It could take you years to get that unless you got into flipping and you were remodeling and you added some value some way. But if you're just holding it, hoping for the price to go way up, that could take a long time, right? And so typically when you buy real estate as an investment, you would want to use it as cash flow, right? So you purchase the property, you rent it out, and then the amount of cash that's coming in each month, it adds to your income stream, right? So this is another great investment. And then third, after that, then I would get into equities. Equities are things like stocks, bonds, that kind of stuff. The reason is these are very consistent income streams, right? You want to have consistent income streams established prior to parking your money somewhere and trying to let it earn interest, right? So once you get these going good, then you can take your returns from that if you want and start putting some of that into things like equities and stuff. But until you have your income streams established, that needs to be a priority. All right, so all of that was kind of a personal finance explanation of return on capital that you want, no matter whether it's your personal finances or a business, you want to make sure that you are putting your money to good use and that at the end of the year, you made money with your money, right? And that's what return on capital is. What did you make with the money you had, right? Capital is how much you have. Return is what you made. What did you make with what you had? And that's kind of the primary, in my opinion, fundamental variable, right, that you would look at if you're wanting to evaluate how well a company is doing, because ultimately that's what they're trying to do, right? Whatever decisions they make, whatever things that they're moving towards, ultimately they should be trying to have a solid return on capital. There may be a year or two where they say, hey, we need to put a lot more money into research and development so that we can come up with a new product. That would be an example of where a low return on capital is still okay, right? If they've put a whole bunch of money into researching this new product so that in the years ahead they're going to have this great product that's going to produce a lot of sales, in the beginning when you dump all that money into research and development, you're not making anything back because there is no product to sell yet. You're still trying to develop the technology, you're trying to get the product refined so that it will produce money. And so there could be valid reasons for short term, 1 or 2 years, where a company has low return on capital, if it's something along those lines. Most other reasons for low return on capital is that either it's not being run efficiently, it's too high in debt, right? Because if you're just like in your personal finances, if you run up a whole bunch of bills on credit cards, before you know it, you're paying all this big monthly bill, most of it's going to interest, and you're not getting anywhere. And all of a sudden now you have a lot less money, free money to spend on other important things because it's all going to interest, right? Well, same thing with a business. If they have too much debt, they could be really successful and still not have spending cash and capital coming back in because it's all going to creditors that they use along the way. And then another reason for poor return on capital is just maybe the business industry itself is not very good, right? And so maybe they don't have good products, maybe they don't have good quality into their merchandise, maybe they don't have good customer service, maybe their marketing is bad. I mean, there's a bunch of reasons why a business could have low return on capital. There's very few reasons why low return on capital would be good. So like I said, if there's an extenuating circumstance, like they've got some big technology that's coming out that's going to launch them into the future, and so they've taken a few years where maybe they have a less coming in so they could put more money into their research or something like that. But other than that, low return on capital is bad. So if you're evaluating a company, you want to know what did they make with what they had. And if you're evaluating your own business, this is probably the primary indicator that you're going to want to point to, right? So if you do a monthly financial statement of some sort, quarterly financial statement, at a bare minimum as a small business owner, you have to do an annual financial statement so you can do your taxes, right? So whatever frequency you do it, whenever you are tallying your monthly, quarterly, yearly total, you ought to take a second and say, what did we start with? How much did we make? And what is that percentage, right? And then make a note somewhere, return on capital for first quarter was 4%, or whatever it was. So that gives you a very quick thing to look at down the road, right, to see if your company is still growing. Because saying, just to give you an example of why it's important for you to keep this percentage recorded somewhere, because it can get confusing when you grow. Let me, just to give you another example. Say if down the road you've grown some, you got some extra capital in, something happened. Say you sold a piece of real estate that you had owned and you invested that money in your business, right? So now you have $500,000 in capital. So you had $100,000 last year, but you sold your house and you had a lot of equity in that. And so just for the sake of this example, you invested a lot of that money back into this business because you want to see it boom, right? And so you put this money in, you've got $500,000 in the account now, right? And so you more than doubled your income. You only made $10,000 last year. So you invested this money in your business. So while you're doing the business, things seem like they're really booming because you have almost 3 times more business than you had the year before. And so while you're actually running the business, you're much busier. You've got a lot more sales. You've got a lot more things to do. Things are preoccupying your time because you've got almost 3 times as much sales. And so when you're living in that moment as a small business owner, if you haven't done the math and if you haven't been keeping up with your stuff, it's going to feel like you're doing a really good job, right? Because you're busier than you've ever been. You brought in more money than you ever have. Things are growing faster than they did the year before, and it feels like you're doing a really good job, right? And so, but if we do the math, right, that now we have $525,000 total, right? And if we were to look at this, that the return on capital is only 5%, right? So when you had 100,000, you brought in 10,000. That was a 10% return on capital. You sold that house, put some money in your business. Now you've got 500,000 in there, and you made $25,000. Business feels like it's booming, but that's only a 5% return on capital, as opposed to the previous year you had a 10% return on capital, which means that for what you had to work with, you're actually doing less with it. You're not as productive as you were before. You weren't seeing as high of a return for the investment that you're making this year. And so even though you're busier, you've got more sales, you're actually seeing a much lower percentage of return. And so that would cause you to say, hey, last year I made a 10% return on the money that I had. I want to at least keep track with that. I should have at least been closer to 50,000, which would have been 10%. In this scenario. And so the reason why keeping the percentage is important is because as your company gets bigger, you will have a lot more sales, you have a lot more things going, and it becomes much harder for you while you're doing the day-to-day business to realize, am I as productive as I was? Because the 25,000 still feels really busy compared to the year before, right? And so if you're not careful, you will judge your effectiveness on how busy you feel as opposed to coming in and doing the math. And so you may feel like you're a lot busier, but the math says this year's return was 5%, whereas last year's return was 10. So it would cause you to say, hey, wait a minute. We probably need to think through how we're using this extra money because we didn't really maximize it like we did before. And there might be reasons for it. Not to say that you always will have the exact same percentage every year or that you'll always grow. But it does become a point of observation for you. It allows you to step in and say, wow, why is it that we made 10% the year before and only 5% this year? Does it have to be that way? Were there some things we could have done differently to have at least maintained the status quo from last year and made at least a 10% return last year, right? And it gets you to start asking the right questions about your business to make your business successful, right? So, probably that's all we'll do on this video for now, and then we'll come back in next week and finish up a few of these. But this is the cornerstone variable that you're going to want to look at in your company and in other companies. So just like in your company, if you're not doing good here, right, then it causes you to ask some questions. Same thing from an investor standpoint, right? So if we're going back to the fact that this is information that investors will use as well, let's think about why. Why would an investor want this? Well, just like you can start asking some questions. If you say, hey, last year we made 10% return on capital. This year we only made 5%. Why, right? We need to know why. And so as an investor, if they see some, these are going to be larger numbers on a larger scale because they're investing in public corporations, and these are going to be hundreds of millions and billions in sales as opposed to these numbers of a small business. But the idea is that the percentage still works out the same, right? And so as your business booms and gets even bigger and bigger, you can still go back and look at the percentage very quickly and very easily to see, are we doing the same amount of return even though we're much bigger now? And so as an investor, you would step in and you could look immediately to these return on capital numbers and say, wait a minute, last year they made 10% return on capital. This year they made 5%. Why? What happened in the company that caused them to be less efficient? It caused them to produce less with more, right? And then if the answer is not suitable, then you wouldn't want to invest, right? If the answer is, well, leadership just isn't doing a good job, or if the answer is other competitors came out and they took a lot of their market share, or if the answer is, their customer service is so bad that it's starting to push customers away. Whatever the answer is, when you get the answer, it will tell you a lot about what you want to know about whether you want to invest in that company or not, right? And it works the other way. What if last year they made 5% return and this year they made 10% return? But they're still maybe a small company. This is what a lot of investors are looking for. okay, their return on capital has increased, but they're still kind of a small company. Maybe now's the time for me to get in, because when I ask the question of why did they go from 5% to 10%? Because now this company's growing. Then you go in and look and say, well, they're managed well. Their product is really good. It's got a lot of quality built into it. Their system is efficient. And you say, man, I think I found a winner. Let me go ahead and invest in them and see how high they can rise over the next 3 or 4 years and see if I can get a good return on my money, because this is a company that I can tell by looking at the math is moving in the right direction, right? And so that's really what you want to be able to do as an investor. You want to have something that you're looking at that's telling you the story. If you're going from 10% to 5%, that tells you a story. Something's going on there. And conversely, if you start off at 5% and now you're up at 10 and 12%, something's going on that's causing that change. And by doing the math, it helps you to see what questions to ask, right? And helps you to see, what am I looking at? Am I looking at a company that's going backwards? Am I looking at a company that's going forwards? And if so, why? What's causing them? Or am I looking, has it been 5, 5, 5, 5, 5 for the last several years? Are they stagnant but yet still producing something? Then that gives you a whole other set of questions. Maybe they're not trying to grow. Maybe they just want to be stable and have income consistently, right? Sometimes like a utilities company. They're not trying to boom. They've only got a contract for their county, right? So they're just trying to manage their county and do it well and have a consistent return coming in. And so for them to have 5, 5, 5, 5 all the way across is probably fine, right? And so the math itself helps you to begin to see the story. And as an investor, it begins to point you in the right direction so that you ask the right questions, right? If you don't know that they're going backwards, then you don't know to look for what's causing them to go backwards, right? If all you're doing is watching their commercials, and listening to what they say, you don't really know the true story. And so if you can go in and see, wait a minute, their sales have doubled. They're putting a lot more commercials on TV, but their actual return on capital is going backwards, right? Because this same scenario can happen for a large company. They could see some increase in sales, right? And so all of a sudden, you see more commercials, you see more advertising, better packaging maybe. But maybe their return on capital is going down. Maybe they're spending too much in commercials and they're not making as much money back or whatever, right? And so then you can step in and say, wait a minute. On the surface, it looks like they're booming. But in reality, I can tell they're going backwards a little bit because some of those decisions are costing more than what they're producing, right? And so as an investor, this is where you start, right? You start with the math side. You start with the financials. You go in here, you look at return on capital, right? Because this is the cornerstone variable. And in your own business, you want to make sure that you're recording this, right? You want to make sure that you are keeping this, probably I would recommend on a quarterly basis, at least, right? Quarterly basis. Sometimes if you're doing like a small business, if you're trying to do these numbers every month, then you miss the picture because it's, you're not big enough to do it every month and it make a real big difference, because you're still small, you're still growing. But on a quarterly basis, right, because you don't want to burden yourself with so much paperwork that you can't keep your business up and running. But on a quarterly basis, every 3 months, you come in and say, okay, how much capital did we have? What did we earn? What was our percentage? And keep a notebook of that, right? And monitor that and find out, are we growing? What did we do back then that caused us to have a higher number than we have now? Or what is it that we're doing now that's causing our number to go up? And then all of a sudden you identify some really good decisions, right? And so this is a good number to begin your analysis with, okay?